All right, so if you look at the investments that I make on my channel that I share with you, you'll see that I'm very intentional with what companies I put my money in. I don't just put money anywhere. Every company that I invest in goes through a strict vetting procedure before I actually buy shares of the company. And this is part of my dividend value investing strategy, which has been my strategy since day one, and I continue to stand by it today. So that's what this video is all about today. I'm going to tell you about how the book Dividends Still Don't Lie has shaped my investing strategy to date, why I continue to stand by it, and to what extent I still apply the lessons from the book today. So let's get right into the video. Welcome back to Millennials with Money. My name is Johnny. Now, a dividend, I'm sure most of us watching the video know what it is, but for those who are maybe new here or who are new to investing, so a dividend is a payout that a company makes to its shareholders. It's typically in the form of financial compensation, and it is a way in which they bring value to shareholders that have invested their money, have put their faith in that company to generate them income. In investing circles, dividends are generally regarded as an indicator of financial health. Hence the title of the book, Dividends Still Don't Lie. Now, as much as companies do have to report their earnings in a specific way and complying to particular international financial reporting standards, that doesn't actually stop CFOs from presenting some information as they want to see it. So what that means is that they can throw in a bit of creative accounting to make the numbers look better than they might be in reality. But as the title of the book suggests, if a company can continue to pay out regular dividends without interruption, then it's generally a good indicator that the company is in good financial health. Now, I say this with the caveat that you should look at the payout ratio, because there are some companies that continue to pay out good high dividend yields, but pay out a lot of their dividend, which over the long term is not sustainable, and it's also not healthy for the company. Now, the dividend value investing strategy, if I was to sum it up very quickly, is essentially looking for high quality companies that are trading at an undervalued share price that pay a good dividend yield that is expected to continue over the long term. The underlying theory of this strategy is that dividend yields and stock prices have an inverse relationship. That's to say that when the stock price is low, the dividend yield will be high, and when the stock price is high, the dividend yield will be lower. And it also says that the dividend yield is a major driver of the stock price. So whilst that dividend yield is high, then it's going to appear very attractive to investors, which will push up the price. And then over time, as that dividend yield gets lower, then a lot of investors will start to lock in their profits and sell off, and there'll be fewer new investors trying to buy the stock because of the yield being lower than it was before. So how do you know when to buy and when to sell? There's a few indicators to look at to determine whether a stock is undervalued or overvalued. The two main ones suggested by the book are using channels looking at the stock chart, which typically will follow a waveform, and you can determine channels at which the stock has hit undervalue in relation to its random path, and overvalue as well. And another indicator is the price to earnings ratio. If you look at that historically, you can tend to figure out a trend as well. For the more experienced investors watching, I know what you're thinking, and yes, this is timing the market, but bear with me, I will come back to this point near the end, as I'm going to give you some of my own thoughts on this, so stay with me. So coming back to the strategy now, if you go by the book, there are 6 key criteria that you must strictly apply to every company that goes through your investment vetting process. And by applying these criteria, you'll essentially get rid of 98% of the companies on the S&P 500, which is crazy, right? But at the same time, it makes sense, right? If you're investing your hard-earned money from work into the stock market with the hopes that it will grow and build wealth over time, then you want to put it in companies that have prospect of survival and growth and regular uninterrupted dividends over the long term. And if you're at pension age and this is your retirement pot that you're living off, then this is your money that you're living off essentially. So again, same thing applies. You want those companies to be around. You don't want them to disappear with your money and then you have income problems as a result. Now, let me walk you through the 6 criteria. So number 1 is that the company has increased its dividend in 5 of the past 12 years. As I mentioned earlier on in the video, a dividend is a good indicator of a company's financial health. So if a company is continually increasing its dividend, then generally it means that their earnings, their revenue are going up and that the company is performing well, such that it allows them to pay out more of its profits to its shareholders, which is obviously good news for you. As I said though, the only caveat here is that you do need to pay attention to the payout ratio. Depending on the company, ideally this would fall between 30 and 65% of their net profit, as anything above that would become simply a bit unsustainable, and over the long term it could create cash flow problems for the company. The second criteria is that the S&P quality rank has the stock in the A category or better. Now, essentially this quality rank, the S&P quality rank, it ranks companies based on their dividend growth and earnings growth. So the companies that have the best earnings and dividend growth are typically the highest ranking companies in there. So you've got above average companies, which are from A+ to A-. You then have average companies, which are B+ to B, and then below average companies are B- to C- essentially. So obviously the best companies are going to be within that A category in terms of revenue growth and dividend growth, so that's why you'd want them in there. Obviously, if you're investing in European companies, then you're not going to be able to find them in that S&P quality rank. And unless I'm mistaken, I don't think there's a similar referential framework in Europe. So in the next section of the video, I'm going to tell you how I assess European companies for quality. Criteria number 3 is that the company has at least 5 million shares outstanding. Now, this is all to do with liquidity and ease of transaction. So if you want to sell the stock at any particular point, it'll be easy to find a buyer. And again, I'll talk about this in the next section, as I think some things have changed since this was written originally. Number 4 is that the company has at least 80 institutional investors. Now, the reason with this is because institutional investors typically have large holdings in the company. And if one institutional investor makes a big move, so a buy or a sell, it can have a big impact on the price of the company. So the idea is that by having more institutional investors, then that risk of major fluctuations in the share price due to activity of institutional investors is minimized. A real life example demonstrating this that comes to mind is that of SoftBank and Tesla call options last year. So SoftBank obviously bought a lot of Tesla call options. We all know Tesla's share price went to the moon, as Elon Musk says. And because SoftBank's activity provoked such a big change in the share price, this is where the whale comments were coming from. So SoftBank was known as a whale in the market at the time. So in situations like this, it's good to have more institutional investors investing in a company because that impact would, in theory, be reduced. Number 5 is that the company has 25 years of uninterrupted dividends. Now, 25 seems like a really big number, but it's actually very intentional. Based on economic modeling, 25 years is more or less the time that it takes to complete 2 full economic cycles, from a recession up to a boom, down and up again. So if a company can go 25 years without interruption to its dividend payments, then it's a good indicator that it's very durable over the long term, and that in all the stages of the economic cycle, whether the economy is doing great or whether it's doing terrible, that you as an investor are very, very likely to still receive your dividend unless something particularly exceptional happens. And rule number 6 is that company earnings grow in 7 of the last 12 years. So obviously if a company is continually able to increase its earnings over the long term, then again, good sign that it's durable, that it's able to move with the times, and that, yeah, it's going to be around for a long time. Now, the book talks about earnings here, which traditionally refers to net profit, but I also like to look at the revenues here because ultimately, this is where the profit comes from. It starts at the top and then trickles down. So I look at both, actually. I look at the revenues and the net profit. So now I'm going to talk to you about the extent to which I still apply the lessons from this book in my investing strategy today. So let's start with the revenue and earnings. I do pay very, very close attention to this. I do want companies that are growing their revenue constantly, that are growing their profit constantly, because as I just said, you want them to be around for a long time. You want to see that they're durable, that they can adapt to changing times. So a good sign that they're able to do so is that they are growing their revenue and their net profit. I also look at other financial metrics that aren't necessarily related to the growth of the company, such as its debt situation, the current ratio on the balance sheet, its gearing percentage, so how much of the company is being financed by debt, And I also look at the cash flow statement as well to see what the company's cash flow is like. Is it regular? Is it stable? Are they paying back a lot in debt? I like to look at these things as well, just to be sure that the company is definitely on the right path financially. I also apply the criteria regarding dividend history and dividend increases very, very strictly as well. From personal experience where I have applied this, the dividends have continued to grow in the companies that I've invested in. And when a crisis like last year happened, I saw very, very few dividend interruptions. The only dividend interruptions I saw actually were in European banks, and that's because the European Central Bank essentially issued strong guidance to advise against banks in the Eurozone issuing dividend payments during the pandemic. Now let's come back to the good old argument about timing the market versus time in the market. So yes, I buy companies at undervalue. I try to buy them when they're undervalued, but I then dollar cost average onwards from that. On one hand, yes, the stock market is incredibly volatile. You never know what could happen, and dollar cost averaging is a good way to even out the risk in that sense. And also, if the stock then goes down afterwards and you're still buying in, then you lower that average price that you bought in at. On the other hand, do you really want to overpay for a stock if there is a way where you can more or less find out when it's undervalued? Personally, I don't see the point in buying a stock when it's overvalued, when it's at all-time highs generally, particularly when it comes to dividend companies, like the blue chip companies that I generally invest in. If it's like a Tesla or an Amazon, yeah, it's a different case, but generally it's much easier to predict the random path of the stock price when it's an established company. So that is my justification for that. And just to say, when it comes to ETFs, I don't take the same approach. ETFs, I do just dollar cost average in constantly, because as we've seen with ETFs, they generally replicate a market index, and those market indexes over the long term tend to go up. So it's not quite the same case as an individual stock, in my opinion. As I said, when it comes to the S&P quality rankings, we can't really do this with European stocks. So that's where I'll do that classic financial analysis that I mentioned earlier by looking at the dividend growth, the earnings growth of the company, and looking at some of the other indicators like the debt and leverage situation as well, because these for me are all indicators of a quality company. And finally, when it comes to the liquidity, when it comes to having at least 5 million shares, now I don't really apply this one. And the reason is because this book was written in 2010. In 2010, there was no trading 2-on-2, there was no free trade, there was no eToro, no DeGiro, etc. You know, investing has become a lot more accessible, and stock trading and buying and selling investments is a lot easier than it was probably in 2010, where it was important to know about having a buyer and a seller of the stocks. Unless today you're operating with some really small, obscure company that no one's really heard of, then generally for the larger companies, you won't have any problems buying or selling stocks on the retail investing platforms that there are today. So yeah, for that reason, I don't really apply the 5 million outstanding shares rule, just because I think investing has changed quite a lot, actually, very quickly over those 10 years. But yeah, it's much easier to sell shares today than it was 10 years ago. And for the 80 institutional investors, I don't pay too much attention to it, honestly. I do look at what institutions are holding shares in the company sometimes, but it's not really a focal point of my analysis. So I'd say that I don't apply that one too much. So drawing all of that together, you can see that dividends still don't lie has heavily influenced my investing strategy from day one up to today, and that I stick by a lot of those key principles in my investing that I do today. And I can say that as a result of this strategy that my returns have been really good. If you look at my trading 2-on-2 investing pies, then generally the results month to month are really good. Also in the portfolio that I don't share publicly, I'm up about 20% overall. So annualized over 2 years, it's like 10% annually. So it's done me well. That said, I have adapted it a little bit. Of course, this is written about 10 years ago, mainly for a US audience. So I had to adapt it a little bit to make it applicable in Europe. And of course, the investing landscape has changed a little bit since then. Hence, I don't apply so strictly that 5 million outstanding shares rule. But as much as I stick strongly by the strategy, you know, there's no one correct way to do investing. There's other investors that have their own criteria, and other people invest more in growth stocks, for example. So these criteria can't can't be applicable. But ultimately, I think you just have to have your criteria, your approach, and you need to stick by it and be convicted by it. That's how you'll give yourself the best chance at succeeding. Because if you're too lenient in applying your strategy, or you change your strategy too often, then that's when you're going to end up losing money investing. So really, yes, I stand by dividend value investing, but honestly, it's just about having a strategy that you stick by and that you're strongly convicted by. Let me know in the comments, guys. I want to know, what criteria do you look for when you're investing in a stock? Do you invest in dividend stocks or growth stocks? Let me know down below. Now, if you enjoyed this video and you want to see more similar content, then make sure you check out these videos. And if you're not yet subscribed and you want to see more great content like this, then make sure you hit the subscribe button with the notification bell. I'll see you on the next one, and let's get this money.